Buying into crypto, what could possibly go wrong?
Now to the cryptocurrency crash that has traditional markets on edge.
Fraudulent scheme designed to take advantage of unsophisticated investors.
Losing more than 80% of its worth.
Cryptocurrency is not a safe haven.
This is fine.
If you've recently become crypto curious, either because of the things you've been seeing online or maybe because of things you've been hearing from people around you, you might be considering jumping into crypto, or you may have already bought some crypto. And now you're asking yourself, did I make a smart decision here? Congratulations, you're in the right place, because today I'll be sharing with you some of the wonderful ways you can YOLO into crypto, lose it all, and wind up in a van down by the river. All jokes aside though, we will be covering some serious things in this video, but it's not all doom and gloom. What's important is to understand what the risks are and how to minimize or mitigate your exposure to those risks. Here are some of the ways bad actors in the crypto space have tricked other people into practically giving away their investments, and in some cases actually handing over their investments. First up, let's talk about sending your crypto to the wrong address. If you hold your crypto in a self-custody wallet, sort of like a MetaMask or Phantom, Tangem, or one of the dozens of other wallets out there, the wallet address will be a unique address, sort of like a bank account number, a phone number, or a home address. And just like you can have multiple bank accounts, you can also have multiple wallets. Now, while most transactions can be done digitally these days, if you've ever had to send a check to someone, there's the potential of mailing that check to the wrong address. But the nice thing about checks and even credit cards is that those transactions can be stopped or even reversed. However, with crypto, when you send your crypto to another wallet, it is immediate and irreversible. It's sort of like mailing money to somebody else. It's not likely that they're going to mail that money back to you. But that's not the only problem you face when it comes to mixing up wallet addresses. Address poisoning is where an attacker will send a small amount of crypto, and in some cases no crypto at all, to the victim's wallet using a wallet address that is nearly the same as the wallet address of the wallet owner. Now, to help illustrate this point, I'll show you an example on the screen. Because wallet addresses are fairly long, most wallets shrink the address to make it easier to see the first and last sets of digits, as you can see here. For count 1, it shows a 0x4fa ... The rest of the address is in those dots, and the end of the wallet address is this FC77. Same thing for account 2. So what the attacker will do is they will create a wallet address that looks very similar to account 1. So you can see on the scammer account in red here, it shows a 0x4fa ... FC77. Looks nearly identical, just in this shrunken down version of the wallet address. What they'll do is the wallet address in the middle of all this will be slightly different, and then they send some small transfer from their wallet address account to this other wallet address, in hopes that when you send money from your account 2 back to account 1, you will use the address they shared with your wallet. So how do you avoid this? The easiest way to avoid any of this and still invest in crypto would be to invest in the Bitcoin ETF through investment companies such as Fidelity or BlackRock. However, if you really want to control your own finances, hey, real quick, have I told you about our community? If you're watching this video, it probably means that you're somebody who believes investing in crypto is a good idea. Here at Prime DeFi, we help educate people with no investing experience in crypto do just that. When I got started, I was really nervous because I had no financial background, I knew almost nothing about investing, and I knew very little about the crypto market. I wasn't sure if I'd be able to do it because I'd failed at some other things before. Now that I'm actively investing, I'm more confident in my decisions, and I'm helping to get the word out about our community. Click the link below this video to check it out and get more information if you're interested. Now let's get back to the video. Then the best way to do this would be to open your own self-custody wallet. Now, by opening a self-custody wallet, it does expose you to the risk of things like address poisoning or sending your crypto to the wrong address. And there are ways to mitigate those as well, even when you have your own self-custody wallet. One thing that you can do is you can double check the wallet address prior to sending your crypto anywhere. Now, if you're making lots of transactions, or if you're really short on time, it can be really time consuming to check that entire address. There are a couple alternatives though. One thing that you can do is you could send a small test amount. So instead of sending 100 or 1,000 or multiple thousands of dollars from your wallet to somewhere else, you could send a small test amount of $1 or $5, right? The other option that you have is something known as an allow list. Coinbase, which is a centralized exchange, has a feature which gives you the ability to limit your transactions to only the wallet addresses that you choose. Now, because Coinbase is a centralized exchange, it only limits you to being able to send funds from Coinbase to a self-custody wallet. If you want to send funds from one self-custody wallet to another custody wallet and limit the addresses as far as where you can send transactions, there's another company called LedgerX that gives you the ability to set an allow list for your self-custody wallet to send it to other self-custody wallets. The one thing to keep in mind when using something like LedgerX is that platform in particular has a 72-hour waiting period or approval process before they will allow you to send funds. One other thing to keep in mind is that LedgerX is not necessarily a self-custody wallet. It works with your self-custody wallet. So if you have MetaMask or Phantom, LedgerX would be used in addition to your MetaMask to add that extra layer of security for you. This video is not sponsored by Ledger. However, I do use Ledger for my own transactions. Next up, we have honey traps. These just basically sound like too good to be true opportunities that you can quickly benefit from, which you end up losing out in the end. The first time I saw one of these honey traps was inside of my self-custody wallet as an NFT or non-fungible token. What the scammers do is they get a bunch of wallet addresses and then they just send almost like an email blast. They'll send these NFTs to all of these wallets in hopes that someone will click on the NFT, click the link, go to the website, do all the things they want them to do, like register and give them their password or their keys to their wallet, and then they will drain that wallet. The other thing that I've been seeing recently, and I'll share a screenshot here, is as I was scrolling through YouTube, I saw an AI generated or AI manipulated video of Michael Saylor, who is the CEO of a company called MicroStrategy that buys a lot of Bitcoin. And it was a video of Michael Saylor basically telling you to send them 1 Bitcoin, and for every Bitcoin you send them, they will send you 2 Bitcoin back. All you had to do was scan the QR code, go to the website, and fill out all the information for them to send that to you. Basically, what they're trying to do is get your wallet information, get your access into that wallet, such as through your keys or through your passwords, to get in your wallet and then drain that wallet of whatever funds are inside of it. So don't click the links, don't follow those scams, and don't give them your information. The next thing to look out for are shady developers, or more specifically, something called rug pulls. If you're not familiar with the term rug pull, it's when the cryptocurrency or NFT developer promotes a project to attract investors only to shut down the project or disappear completely, taking the investors' money with them. So how do you identify a rug pull? I did a quick screen recording so you can see what one of these websites look like. However, it's best to do your own research, because while these rug checkers claim to be able to identify a rug pull before it happens, there are some other red flags to look out for. One of those would be unrealistic promises, where they're pitching the opportunity to make money more than they're talking about what value the project actually has. There can be a sudden spike in the token value, which is not completely uncommon in the crypto space, but it is something to keep an eye on or take note of if you see that with the project. Most utility token projects will have white papers on their website that you can read through that will explain what the project is about and what they aim to accomplish. And if you're on that website and looking through their paperwork, and if there's any sort of hidden clause that states that there will be some sort of withdrawal penalty, or they could freeze your assets to hold on to it longer, that may cause you to want to pause and reconsider your investment into that project. Now, for something like a meme token, they don't tend to have white papers and all these kind of formal documents, but still, if there is any sort of hint towards your investment, removing your investment is subject to conditions, take a look at it. There's other things you can look at, such as the community and the support they have around them and people talking about the project. What are people saying about the developers and the team and the project itself? Another red flag would be lack of code transparency. Projects that don't have their code audited or don't allow it to be available for public scrutiny can be more susceptible to rug pulls. And lastly, another red flag would be anonymous developers. Check their site, check their white papers, check their social media, look at their communities, see who's talking about them, see what they're saying about these projects and about the teams. If these developers have worked on other projects that have been successful and have not done rug pulls, then there's a good chance that that they wouldn't do that for this particular project that you might want to invest in. However, if they don't have any sort of proven track record, then you may want to be a little bit more skeptical about investing in the project. Which leads me to my next point of high risk versus low risk. New, unproven projects can have a large upside of those 10x, 100x returns on investments. However, they do expose you to a lot of risk because those projects are unproven and they can go to zero. Lower risk investments might not yield as high rewards. However, there's a better chance of a return. While I'm not a financial advisor, it is a good idea to not invest more than you're willing to lose. Another challenge you might face is buying the wrong token or coin. Now you might be wondering, how could anybody buy the wrong thing? So one thing that kind of plays to the favor of scammers is that one token can actually have multiple addresses. So for example, if you wanted to buy the Render token on the Polygon network, Render has a specific address for you to buy that token on the Polygon network. However, you can also buy Render on Solana, which the Render token has a different address for you to buy that token on the Solana network. So that means that one project can have multiple addresses, making it easier for scammers to create a token similar to Render, and then offering that token for people to buy on a different network where Render may not exist yet. So scammers will also create fake tokens on the same exact chain as an existing token. I've seen this happen a little bit more so with meme coins. So if there's a popular meme coin, they might create an offshoot of that meme coin so that people would hopefully buy that token instead of the actual popular one. Now, one last way I've seen scammers make use of fake tokens to their advantage is by creating tokens for projects that have not launched or released a token. This happened with Jupiter, which is a decentralized exchange. It was getting set up to launch a token. However, there were scammers posting tokens on platforms on the Solana platform that were Jupiter or some offshoot of the name of Jupiter in hopes that people would buy their Jupiter token. So you might be wondering, how do I avoid buying the wrong token or coin? You can make use of established resources such as the tokens website or other websites such as CoinGecko or CoinMarketCap. Now, when going to the token website or the coins website, you want to make sure that you're typing in the correct address, because there are scammers out there who will create a fake website that looks just like the original website. So for example, OrcaScan, which is a decentralized exchange for Solana, there have been people that create orca.com or orcascan, and they create these like web addresses that seem like it would be that platform, but it's not. So by going to the correct website and verifying the token address, that's how you can know you're buying the correct asset. Again, websites like CoinGecko and CoinMarketCap are a good place to verify those assets. One other thing to keep in mind is that if you're using a wallet such as a MetaMask, you will have to get the token address to add to that wallet so it shows up in your wallet and you can see those tokens there. So that's another way you can know you're getting the right token, because you already have to populate that token address into your wallet. So it's another way to check and make sure that you're buying the correct token as you go on and go to buy other ones. So not making the mistake of, just because you bought Ethereum this time, you go in and buy something else that has a couple digits off and it's not the same as the token address that matches inside of your wallet. Now, another challenge you might face is not just what to buy, but when to buy. The first thing to avoid is buying the pump and selling the dip. But what does that mean? Buying the pump is getting FOMO and buying an overhyped token or asset as the price is shooting up 20, 30, or even 100% or more in price. Then there's a market correction where the prices start to come back down into a realistic range, and because you're afraid to lose all of your investment because you think it might go to zero, you sell off all the tokens that you bought at a discount, and now you're left with a loss. The best way to avoid this is to understand what type of investor you are, what's your investment strategy or plan, and also, who are you paying attention to? Are you paying attention to the pumpers who are just trying to hype up a token so that you'll buy into that one and that they can turn around and sell off their tokens to you at a profit? Are you paying attention to the financial gurus who are telling you things like, do as I say, not as I do? I came across a post on Twitter or X where they shared a post from CoinMarketCap that was a quote from Jamie Dimon, who's the JP Morgan & Chase CEO, in which he's quoted as saying, Bitcoin is a decentralized Ponzi scheme. However, in another post where banks were forced to disclose their holdings of spot Bitcoin ETFs, you can clearly see that JP Morgan and Chase has been buying up Bitcoin. While there seems to be no shortage of bad actors looking to get between you and your investment, there are plenty of good actors who are working tirelessly towards making decentralized finance and decentralized projects safe and secure for everyone to use. Decentralized exchanges, token bridges, smart contracts, even crypto wallets, anything within the crypto ecosystem is susceptible to attacks by scammers. But the same is also true for traditional finance. Banks have been robbed, ATMs have been broken into, and cash can be stolen in many different ways. But security has gotten better and better, and we've found ways to minimize the risk of losing our money. The same goes for crypto. As the space grows and as vulnerabilities get exposed, security continues to get better and better. If you're new to crypto and you want to dive deeper on this topic, be sure to hit the subscribe button to get the latest posts from Prime DeFi.